Good afternoon, everyone. I'd like to welcome you all to the Halftime Talk feature interview. I'm delighted today to be joined by Dr. DIlia Bouchouev, Managing Partner at Pentathlon Investments, and soon to be published. You're already an author, but your new book that's coming out is called Virtual Barrels, Quantitative Trading in the Oil Market. Now, we're not going to get too technical today, Dr. Bouchouev, forgive me, because some of our audience are not traders or hedge fund managers, but we would like to get your perspective of what the trading community could be thinking at this time in the energy markets, how it's making its bets, how it's reading the signs, right? Which probably have changed a bit in the last year or so, and indeed the method of interpreting those is probably getting a little bit more difficult. But give us your take first. Let's start by asking you on what you think is the biggest factor that's impacting and influencing oil price direction these days.
Okay. Well, first of all, thank you very much. My great pleasure to be here. And I do promise we are not going to get too technical. So let's start with my sort of a quick non-technical take on oil prices. So why are we sort of at $80 and not even higher? I'll give you a couple of reasons. I'll give you a macro reason, a fundamental reason, and a flow-based reason. Obviously, everybody talks about geopolitical risk. Why are we not higher than at $80? I would say number one reason is the Fed. The U.S. interest rates is really a big deal because it really has a two consequences on oil prices. One, essentially, interest rate chokes economic growth because Fed fights inflation, and that's pretty much what they're trying to do. They want to slow down the growth. So lower growth means lower demand for oil, so that's negative. But I think a bigger issue is probably U.S. dollar. So essentially, when interest rate in U.S. are higher, money goes to where the interest rate is the highest. That increases the value of U.S. dollar. And since oil is denominated in dollars, that means the price for non-dollar denominated countries like China and India is actually quite high. That's also negative. So that's more like the macro reasons why are we not higher. On the flow side, to be honest, the geopolitical risk premium is not particularly high now, but at the same time, I think it's sort of a fair. So we're trading at 80, but if you look at the market like 4 or 5 years out, that's at 70. So if you believe that the $70 is a fair price of oil, then we shouldn't be measuring geopolitical risk premium with price. We should be measuring it more like this backwardation. So what's the difference between spot and forward? $10. So to me, that's fairly fair. So if we believe the fair value of oil is 70, then 80 actually is quite reasonable. And I guess the final point, purely from the trading perspective, that's where I'm coming from. There's just not enough buyers above 80. So if you look at the past, a lot of people willing to buy oil above 80, they were financial macro traders hedging against inflation spikes. You don't need to hedge now because when interest rates were 1% and you have a portfolio of bonds, yes, you do want to buy call options on oil to hedge yourself. But when interest rate at 5% and you own these bonds at 5%, honestly, you don't need to do that. So you actually don't need to waste your capital on buying oil. There are plenty of other alternatives that you can invest. That's why the participation on the buy side is not huge. So sorry, giving you a lot of different kind of perspective. It's a combination of all of that for sure. But that's sort of to answer your questions, why are we not higher than where we are?
Okay, great. That's perfect. That's a great intro, Dr. Bouchouev, on the different things that are influencing that price. Would you agree, as many traders are saying, that actually oil, compared to other commodities or other even products, food, etc., consumer products, is cheap these days? It is not actually, because of inflation. When you adjust for inflation, it's actually a very reasonable price, and is actually much cheaper than it was a few years ago. When you factor in the fact that we've got such high inflation.
Yeah, I mean, I would say it's a fair point. I would generally agree. I wouldn't call it cheap on an outright basis. But if I am an investor in the commodity sector, yes, I would probably allocate more of my bullets today to oil versus, for example, copper or some of the other metals market or agricultural. Again, if I have an allocation to make into commodities, I would definitely allocate more to the energy sector.
Okay, and I mean, and a lot of commentators these days are saying that, you know, oil has taken sort of a relative dip in the last month or so, despite the geopolitical, obviously, events and risks that we've got, because fundamentally and on the fundamental side that, you know, we have a lot of supply, hence why OPEC has been cutting, but also the non-OPEC supply has increased this year. That's expected to continue into next year. Does this put OPEC in a tricky position? You know, it's meeting in a couple of weeks. We already kind of assume it's going to extend the cuts it's done, but people are saying now it may have to cut more. But that puts it in a bit of a bind, doesn't it, when it comes to the impact it wants to see on price?
Well, it's definitely tricky. So that's obviously the biggest question for the trading community. How are they going to exit the cuts? So for now, I think OPEC is doing a fine strategy. So they're essentially replicating the strategy of central banks over the last decades, where how do you impact the market sentiment? Can you impact the market sentiment without actually doing a whole lot? Because your bullets are limited, so you can't spend them all. And effectively, you can hear the comments all the time from Saudi Arabia that it was all speculators, it's a ploy for sure. So that's an attempt to impact the market sentiment. And I think they're doing the right thing. The only problem, obviously, if you take, for example, the recent price action, you're trying to impact the market sentiment, but at the same time, the market is selling off. The problem is the reason that the market is selling off is driven by computers. Computers don't have eyes and ears. So unfortunately or fortunately, they cannot hear what OPEC is saying. Even if they wanted to, they just cannot do that. From that perspective, I think OPEC need to fine-tune the strategy. It doesn't really make any sense to scare away the speculators because they just cannot hear you anyway. But yeah, they're in a difficult position. But I think for now, they're doing fine. And there are other ways for them to impact the market sentiments and essentially force algorithms to become more of a buyer rather than a seller.
Okay, I mean, I wouldn't, but they can't. The computers can't hear OPEC yet, but they will soon with the way we're going with AI and everything else. Let me ask you a bit about that in terms of computers and you know, quantitative trading, etc. The managed money in the market is plentiful, and that has, you know, those net longs that we've seen recently have been flushed out. And again, that's what's influenced, right? Certain things and where the price has gone the last month, regardless of what OPEC is saying, as you said. So how much of this control on prices or lack of control is due to this liquidity in the markets across the board that we've been seeing obviously come in for the last year or two?
Mm-hmm. Let me give you a couple of numbers here, and then we both can sort of make a deduction from that. So we all know we consume about 100 million barrels per day of physical oil. So on a daily basis, we actually trade about 5 billion barrels per day. So it's roughly 50 times more than we consume. That's sort of a one data point to put things into perspective. The other one, I believe in OPEC's last report, there were several comments that speculators just sold 200 million barrels of futures over, give or take, about a month. So you take 200 divided by 30 days, that's 6 million barrels per day. So effectively, over the last month, give or take, speculators sold 6 million of financial barrels per day, and you compare it to Saudi Arabia lollipop, which is a 1 million, that's like 6 times bigger. So obviously it matters. I'm not saying it's 6 times more important for sure, but to put like the sheer size of the financial markets versus physical, absolutely it matters. But I think the mistake maybe that OPEC is making is blaming all of that on a speculation. Well, I would agree 100% with the statement that the recent wave of selling was driven by non-fundamental traders. Whether you can call all of them a speculator or not, that's a more delicate and nuanced question. I would say it was driven by what I call financial barrels, but not all of them are speculators in our traditional definition of speculator. Take, for example, the option traders. So they're risk managers. They're managing their big options position. Like, for example, last Friday, there was a massive over-the-counter option trade. And these deals are happening every single day. This position must be managed. So it almost doesn't matter what OPEC say. These hedgers, they don't even think about the market. They do their own business. So they have other reasons to trade the futures market, not based on supply and demand. So I would kind of agree and disagree with these statements that, yes, the wave was entirely driven by non-fundamental traders. If in the eyes of OPEC, anybody who trades non-fundamental is a speculator, to me, that's wrong or exaggeration. There are a lot of other people trading financial markets, and I don't think I should call them a speculator, but a lot of them are quantitative traders. They are quantitative traders. They're executing mechanically for a zillion of other reasons.
Okay. You mentioned at the beginning, Dr. Bouchouev, about the impact, of course, of the US dollar on prices and the impact that has on consumers like China and India, and sort of the value, obviously, that they have to pay in dollar-priced oil. Of course, we've had Russian oil now under sort of a price cap mechanism for the last 18 months or so. That oil is still flowing. It has been flowing to those countries that are not subjugated to, abide by the sanctions placed on Russia. How much of an influence, if at all, does that price cap mechanism have on traders' thinking in the market, if at all, in terms of the decisions they're making, in terms of their forecasts for prices, and therefore what they're betting on?
I think it's the easiest question, very little.
Okay.
So at least in the communities that I'm in, not a big deal. It's probably not going to make it in the top 10 list.
Okay, well, that's interesting. And even going forward, has it completely, if it was pricing in anything, it's priced that in going forward, even in terms of any further disruption or changes in that cap policy?
I mean, predicting is very difficult, as you all know. In our industry, we don't know what's going to happen. But in the current state of the world, I don't see it being a factor.
Okay. And I mean, we're talking about technicals versus fundamentals, financial versus physical markets that impact the oil price. You mentioned demand at the beginning as one factor why prices have come down. What is the sentiment of the trading community today on sort of the outlook for demand? Obviously, nobody can know what that's going to be. But one thing that's happened this year is that this shallow economic recession even hasn't happened in the US. Europe's doing better than it was maybe a year ago, except for a few economies like Germany. So how can the market make decisions when our macro expectations are so off grid, if you like?
Well, difficult question, right? But let me give you two answers, right? One is sort of very cynical and from the trading perspective, but probably has more craft. And the other one I'll give you as an academic as a professor. So let me start with a kind of cynical answer. So my career was managing the global trading business, so I had to travel a lot. So every time you come to US, you become more bearish. Every time you come to Asia, you become more bullish. It kind of probably makes sense because over the last couple of decades, you were exposed to shale and growth of US production. So you talk to people, basically you see all the supply, and you go to Asia, it's all driven by Chinese demand, you become more bullish. So from that perspective, you talk to traders, everybody is talking their own book.
Yeah.
So you come to US, they tend to talk more bearish. You come to Asia, they talk to more bullish. Now, I mean, again, I hate to be more cynical here, but to a certain degree, I think it applies to forecasters and agencies. So out of the three main forecasters, the DOE, IEA, and OPEC, well, the US is the most bearish one, and the OPEC is the most bullish one. Since I said it's my cynical answer, everybody in our industry is talking their own book. So if you're an OPEC, you actually want to anchor public's opinion on higher demand, because that's your product ultimately. You want your product to be seen in a higher demand. And out of three agencies, the least bullish or the most bearish is US. So they were the ones forecasting the lowest demand in China. So from that perspective, you want to anchor the public opinion towards lower prices or lower demand. So that's like kind of my cynical answer. On more like intelligent, but probably less useful side, I would say the demand numbers, notional numbers are very different, right? You're correct. Like the OPEC is forecasting something like 104 million barrels, but US 102. But year-over-year numbers are actually much closer. So what it tells me is it's not a problem of predicting demand. We can't even measure it today. So like year-over-year, I think it's much more in sync. So, but OPEC is systematically higher on demand than other agencies. So, but it means it's not a problem of forecasting. It's a problem of measurement. So we just cannot even measure this thing today. Forget about forecasting. We can't even measure it for this year. So it ultimately goes down to the data quality. And like since roughly half of the demand growth over the last decade was in China, it really boils down to Chinese demand, and like how reliable.
Which of course has taken, quite a hit in the last 2-3 years, and now you have the new model to the Chinese economy that's changing.
Correct, and you're absolutely correct. And on top of that, again, as an academic, it's very difficult to compare the demand numbers after a big event driven by pandemic, because you have this thing called base effect. So yes, like this year, demand in China was very, very high because your base was very low. So you're still comparing to the low numbers. So effectively, what OPEC is doing, in a sense, they're extrapolating this number because basically they are doing this. They're maybe not adjusting properly for the base effect, but maybe they're right. So again, there's all kind of a statistical difficulties how you do this. When you got a one big event driven by pandemic, it messes around your base numbers and becomes much more difficult. So I think that's one of the more intelligent answers. Is like very hard to do it statistically, especially after pandemic.
Yeah, of course. And of course, China, on the other side of things, it's obviously a large consumer of oil, but also it has a big, very dynamic agenda on the energy transition front, investing a lot in solar and EVs, etc. But let's talk a bit about that transition, just from the perspective of any new sort of instruments, products, derivatives that are being developed with that in mind, for trading going forward, as far as carbon credits, etc. When do you see? I mean, then there's this whole debate about peak oil demand, when is that going to happen? And of course, there's two sides of the argument of how quickly the energy transition is happening and can in fact happen. But is the trading community taking those new instruments seriously? Is it putting much energy into developing that for the forthcoming decade, if you like?
Okay, well, let's. There are a couple of things here to address. On the carbon trading, on that side, I'm somewhat skeptical. There are so many attempts to trade carbon in the past, and the reason for my skepticism, it is not a fully free market. And trading community, it's generally market-based community. While the carbons, at least the supply side, is basically controlled by the government. And if you look at the history of carbon trading, there are so many of them kept appreciating up to a point and then overnight collapse to zero when a new government comes in and with a strike of a pencil just cancels the whole program. I'm not saying it's going to happen, but that's just the history. So it reminds us it's not a true market-based market. So from that perspective, I'm actually quite skeptical. Where I'm more positive on new instruments, there are a few of them for sure. First of all, the energy transition, in my opinion, is going to be slow. We need all sorts of energy of all kinds. The energies are probably going to become more integrated. The market is going to become more integrated. I can see a potential, for example, in further globalization of gas markets, like LNG futures, for example. So far, the gas markets are still kind of regional, but I think there is a potential for gas markets to become a bit closer to oil. Then somewhat, it's not exactly related to energy transition, but speaking of new instruments, the energy transition sort of a change in the flows all over the world. And there are new contracts being developed even in the traditional oil space. Like take, for example, ICE is developing a Permian contract on the Gulf Coast, and WTI is now part of the Brent basket. Right. They also develop an urban contract in Asia. So those second-tier contracts, I think we're going to see more and more of them. I actually wouldn't be surprised that the oil or energy markets are going to become a bit more like equities, where WTI and Brent are benchmarks, but there are all kind of individual energy futures that you can trade regionally and locally because we're actually going to need them. It's not going to be, the energy transition is not going to be in sync across all regions. So there will be more contracts of all kinds. So I actually think it's great for trading because we're going to have a lot more things to trade. And I think finally, I would say one other area that I think is already growing and going to continue to grow is an options market. Because energy transition is going to be volatile. Okay, we all agree on that. It's going to be very, very difficult for traders and risk managers to manage risk or make money because things have become less predictable. So simply betting on the futures market is going to be very tough. And even now, the professional hedge fund managers, nearly all of them are already using options market because it gives them more flexibility. I think this market's going to continue to grow. You actually somewhat seen it already in the equities market, all these stories about Tesla call options. I think that's the direction we are going on the energy space as well. So there are plenty of new instruments, and obviously in the broader commodity space, there will be more interest in things like copper. I'm seeing lithium futures being developed. That's obviously a little bit outside of the energy space. But yes, there will be some development on the metal side for sure.
Okay, that's really interesting, actually, how the energy transition can be triggering sort of more yes, a bit of variety and diversity in contracts. What about this idea that's been thrown out there about, oil being priced in a currency other than the dollar in the future, from a regional perspective, Yuan or even, dirham in this particular area of the world, or Saudi Riyal. Do you think that's realistic?
I think on a physical side, a portion of it could be. On a purely financial side, there are attempts to do it already. I believe the futures contract in Shanghai, I believe it's dominated in the local currencies. From the trading perspective, I think it's also good because effectively it creates more arbitrage opportunities. As a trader, the more things we can arbitrage, the better. So, and if you basically have one type of oil is priced in a different foreign currency, then the arbitrage is no longer between one oil and the second oil. It also has an FX component. If anything, it's going to further integrate at the markets for commodities and the markets for foreign exchange. And I can see some ETF providers are launching different indices where you can trade Brent and yuan or something like this. Yeah, I think it also adds to the overall pool of trading instruments. As far as physical, I don't think I'm the right person to ask. I think a portion of the markets, I think it's plausible for oil to be priced in other currencies for sure.
Okay, that's interesting. One final question for you, Dr. Bouchouev. With your crystal ball looking forward into 2024, of course, there's no, I suppose, accurate final answer to this, but we've been hit by a couple of black swans in the last 3-4 years: COVID, Russia-Ukraine war. Now we have a conflict here in the Middle East, which is extremely uncertain as to how that's going to end up. So, do you expect any more black swans next year? And how, or of course, we don't know the answer to that, but what would be your black swan or your gray swan? And how should the market brace itself for that, if at all?
Well, let me kind of start with a disclosure from a famous Yogi Bear who said predictions are very difficult, especially about the future, right? So nobody knows, right? But let me give you an unorthodox thought here. Obviously, we all know plenty of things that can go wrong. I call them like known unknowns related to geopolitics. I'm not going to even go there. I think we all know what could possibly happen there. But one of the topics that has been on my mind is cybersecurity risk. Mm-hmm. I think just a recent episode in the U.S. Treasury markets where hackers penetrated the U.S. branch of a major Chinese bank. It turned out to be not a big deal, but it reminds us that as the world becomes more unstable, I think this risk are going to continue to grow. I think, remember how quickly we forgot that a few years ago, oil went to negative $40 per barrel, yeah. Kind of a little bit weird. Or nickel has an issue a couple of years later. So in my opinion, honestly, the oil market have not been tested yet. So we don't know how robust the whole operational system is. And especially there could be an issue. What if, we can't predict the future, but given the amount of algorithmic trading that's going on in the market now, what if one of the algorithms goes out of control? So it could be intentionally, it could be unintentionally, we don't know. But I think those risks, again, I hope nothing like that is gonna happen, but that's sort of my black swan event.
Yeah, certainly very, very easy to see how that could happen, even with stop gaps. That obviously there must be things in the system to stop that happening, but clearly that's quite a risk. And Dr. Ilia, just one more question before we wrap up. Would you be risk on or risk off in this market, given the inflationary aspect and the Fed policy background that you've seen?
I'll be just buying US Treasury bonds today at 5%.
Okay, that's good advice. I might take that advice. Dr. Ilia Bouchouev, Managing Partner at Pentathlon Investments. Thank you so much for joining us today on Halftime Talk.
Very welcome. Thank you.